Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, I've been talking again about the markets a little bit this morning before I jump back into the tax planning changes over the 4 stages of retirement. I want to wrap that piece up. I want to make sure that I have you thinking about the markets. And the reason is we're about to hit new highs in the market, right? We're only about 0.5% off new highs in the S&P and the Dow Jones Industrial Average. Now, having said that, and also that we're year to date, we're back up around 20% year to date. So a pretty strong year, and it's only September. So this is good news. However, right, it's not a time to get complacent. It's not a time to think, wow, everything's going great, I'm just going to ride this out. And I know, from talking to people when they come in the office for the first time, right, for new clients, when we sit down and talk, I know they're very nervous, actually. Even though the market's having a good year, there's been a tremendous amount of volatility, a lot of ups and downs, big drops and big gains, and a lot of uncertainty. When you look at the things like China trade talks is one of those examples, right? They start talking about it, and all of a sudden the market, if it's negative news, the market tanks, and if it's really, it seems to be somewhat positive news, the market goes way up. We got Federal Reserve talk, and when they're talking about cutting rates, the market goes up. Then now they're getting into are they going to be 1/4 of a point or 1/2 a point? Even though consensus is still on the more conservative end of that, 1/4, how's the market going to react depending on what the Fed does? And those are all factors. And then, of course, there's a number of other things that get into, concerns about wars and political unrest and all that. All of these can affect the market. Most of it's static. We're looking more about the fundamentals of the market. That means the companies and their earnings and profits and how well they're doing. And when it comes to investing, understanding some of the dynamics when it comes to the market and what's going on right now, this is real important when you're thinking forward, okay? So with retirement planning, we're always looking to the future in the sense that, where are we at today, but how are we going to get to the point we want to be 10, 15, 20, 25, 30 years, maybe even down the road. And that's where this longer view comes in. So when you're investing, that means you want a buy and hold type strategy. You want indexing strategies are going to be a safer way to get a market return. This is how the smart money invests. This is how to invest in the market in such a way that we're going to get the desired rate of return, a market return over time, but with less risk or volatility. And again, I mentioned to you about the last 10 years, average return 13% a year on the S&P. If we look at the last 20 years, it drops, it's only like 4.5%. That shows how bad it was in that 10 years prior to the last 10. But here's the portfolios that I talk about, the modern portfolios, these model portfolios based on the academic research of the last 60 years, right? Modern portfolio theory, the importance of asset allocation. In fact, it's the biggest determinant of what you're going to get as far as return in the market and what kind of volatility or risk you're going to have in the market. So making sure of your asset allocation model, not just haphazardly picking funds because they seem to have done well. In particular, don't look back over the last 1, 3, 5, 10 years and say, oh, well, that's done great, I'll just put my money there. See, that's chasing past return, past performance, and that can really set you up for a lot of disappointment, because what's happening again, longest bull market for large caps, all right, the S&P 500. However, that also means when these are the same ones in the 10 years prior had those two big drops of 45 and 55%. So how do you protect yourself? So the asset allocation modeling can help do that. And these the model portfolios that we use in my office, for instance, and that anyone can put these things together, right? We help you in a lot of different ways besides the model portfolios. But one of the things they've done over the last 20 years, when we're comparing performance again, we had, depending on, from a most conservative portfolio of around 4% average return over the last 20 years to the more aggressive portfolio, more stocks in it, a higher ratio of stocks to bonds, which did about 7% a year. Now, when you put that in the context of the S&P, which did 4.5%, it shows you can get market return, maybe even better than market return, all right, based on how your asset allocation model is done in your portfolio. Now, if you're not sure how to do that, I'm hoping the things that I'm sharing with you help with that. When we talk about the portfolios, when we talk about how to do these things, and I've shared with you in previous shows about how, in more detail about how that's done. But again, get with a good fiduciary advisor. All right, and only about 1% of advisors, according to Tony Robbins' research, there's only about 1% of advisors in the country, I think, 1.5 maybe, that are fiduciaries. So full true fiduciaries. Okay, so seek that out. That's someone that's going to put your interests ahead of all others, including their own. In fact, that's the legal standard to which they're held. And again, if you don't have someone, just give my office a call. We're happy to help you with these things as well. 615-376-5325. You've got that. We'll get it out to you again later in the show. But what I want to stress upon is just doing a stress test of your portfolio when things are going really well. This is a great time, again, just to make sure that you're properly positioned so that you get to hold on to those gains you've got, right? That you've got in the next bear market, you're going to reduce your risk and your volatility considerably, and that's what good planning will help you do, and a good investment model will help you with that. So portfolios, again, great way to go with that. The good time to look at it. Let's see if I've missed anything I wanted to cover. Oh, bonds. This is another area. There's been some recent articles, a number of them, talking about the bond market, all right, and talking about some of the current risk in the bond market, all right. So these have been from Forbes, from Barron's, an economic magazine that we get, and Bloomberg. That was the other one I was searching for. So in these articles, that one of the things that we see in the markets, and you hear talk of as far as on different financial shows and in the news in general now, right? Negative returns on bonds. What they're talking about is governments, right, like Germany and others, Japan, where they're issuing bonds where basically they have a negative return. And what it amounts to is, for instance, they're saying to you, you give us 5% more than this bond's face value will be at maturity, right? It's crazy. So you're paying a premium to buy a bond just to get your money back. It's like buying insurance to get your money back in 5 years or 10 years or whatever the bond might be. And people are buying these. Now the problem with that being is that, and because it's such a low interest rate environment, it's setting up a lot of different dynamics that can affect you as far as your retirement planning. All right, and you're thinking, well, I'm not investing in that. Well, do you know? All right, because the mutual funds you're investing in, bond mutual funds, may well in fact have those bonds as a part of that portfolio. Right? And this is the type of thing when I talk about doing an analysis of your investments and understanding it's not just because I've got a bond mutual fund, right, that I think I'm okay, because I don't know what that bond mutual fund may own. And so it's important to do this analysis where you get a Morningstar report and you look inside and see what bonds they have. You do a little further digging to see what's in your portfolio, because that's adding risk potentially to that portfolio. So there are other parts to this. Bonds were, had a nice run for a time, and now the last 2 years we've had kind of a bear market in bonds. So finding yield in a bond, and I've talked about this part, it's an easy one for you to check into as well. If you see, for instance, in a low interest rate environment and when they're seeking yield, trying to get higher returns in a bond market, how do they do that? Well, typically they take more risk. And one of the ways they do that, and then they hedge that risk possibly with negative return bonds. Another thing they do is they look at long duration bonds. So they're looking at 20 and 30-year bonds, which are very interest rate sensitive. So when it does turn and interest rates start back up again, maybe that's a couple of years from now, who knows? But when it happens, those are going to be much more sensitive to that, and meaning that there are more losses, bigger losses in those bonds. Another are high yield bonds. So if you see high yield bond, think junk bond. Okay, those are highly questionable credit ratings, or low credit ratings. So the corporations that you're loaning your money to when you're investing in that bond, basically, these have low credit quality. So they're paying higher interest to get money. Okay, just like if you got a low credit score, you're going to pay a higher interest rate if you want a car loan or a mortgage or whatever it might be. Well, it's the same when it comes to corporate debt. So understanding that, again, look inside your portfolio. Do you have high yield bonds? So this might be a good time to get out of those. You have long duration bonds, it might be a good time to get out of those and safeguard yourself against the potential losses that's going to bring. So when we look again over the last 10 years, and we see how the markets have done, right? This being in this longest bull market in history, we have to be ready for the next bear market. We have to be prepared to still get the returns. We still want to participate in that market and get those great returns that are available to us, but we also want to have downside covered against risk when the market in fact does go through its next bear market, and we want to reduce risk in our portfolios with regard to these bonds. All right, there's more to that, but first we have to take a break. Join me here. We'll be right back on the Retirement Report. Think a will be enough? Think again. Here's money tip number 41. Remember the Terri Schiavo case in Florida? All that